So let's move toward the strategy. The first strategy would apply when the forward market is greater than forward intrinsic. In this case, we are assuming the forward market is 43 and we have calculated that forward intrinsic is 40.5. So we clearly know that forward market is greater than forward intrinsic. What strategy would we follow then to earn riskless profit, to earn the arbitrage profit? So arbitrager can buy the asset. So this would be the first thing. He need to buy the asset and short the forward contract. So enter into a short forward contract to earn. So you just need to do two things. We buy the asset, we short the forward contract, right? So there are certain things that we need to do today. First one, this is the simplistic, and we would add some more complexity to it, but let's first understand the simplistic idea. So today we would perform two tasks. We are going to buy the asset. Say for example, we buy it, today's market price is say for example 41 or whatever the price is. We buy the asset today and then we also enter into a short forward contract. If we enter into a short forward contract, remember in market the forward contract is at 43. So we would enter into a short forward contract at 43 price. So we make an agreement today, we buy the asset today. What would happen after 3 months? This contract would expire in 3 months. This contract would mature. We would sell that asset at 43, the one that we bought at say 41. Sorry, not it would not be 41, it would be 40, because remember we just said that the spot price was 40. So we would buy it at 40. We would enter into a short forward contract. Remember, short forward contract is the contract to sell the asset at future time at certain price. So we are selling it at 43 in future. When the future comes, we would simply sell it at 43. So as of today, we know what our profit would be. Whatever the price is in the market after 3 months, it doesn't matter to us, because we have already entered into a short forward contract and we have locked the price today. So we call it riskless because we know today that what our profit would be. We have locked our profit, right? Okay, but let's make it somewhat more complex. Let's say we currently do not have money. Okay. So what would we do? We would always obviously borrow some money. So what action today we would take? Today we would borrow $40 at 5%. Remember the risk-free rate is 5% for 3 months. We would buy 1 unit. This is the same as we discussed in our simplistic idea. We would buy 1 unit of asset and we would buy it at $40. That's why we have borrowed $40. We would enter into a short forward contract to sell the asset in 3 months for 43, because today forward price is 43. Then what action would we take after 3 months? We would sell that asset at 43, because that's what we have entered into the contract with the other party. Once we get the $43, what we would do is we would pay the $40 back to the bank from whom we borrowed the $40, and we would also pay the 5% interest. And the 5% interest would be 50 cents. So that would be 40.5 that we need to pay the loan and the interest. If we do that, our profit would be the difference between the selling price and this 40.5. So now you have got an idea that if forward market is greater than forward intrinsic, we would always have an arbitrage opportunity, and this is the step that we need to follow to earn that profit. And you have already seen that even if we do not have cash on hand, then we can even borrow, and even after paying the interest rate, the interest amount, we would still have a profit. Okay, but what if forward market price is less than forward intrinsic? Remember, the second part of the question was that what if the forward market is 39? What would happen? That clearly is less than forward intrinsic. Forward intrinsic was 40.5. Remember, forward intrinsic wouldn't change. The calculation would remain same. The formula would remain same. The only thing that would change is the strategy. Okay, so what do we do if forward market is less than forward intrinsic? We clearly know there is an arbitrage opportunity, that is for sure. Remember, it isn't equal. If forward market was equal to forward intrinsic, we would not have arbitrage opportunity, but in this case we clearly have an arbitrage opportunity. So what do we do? How do we earn profit? For arbitrager, they would enter into a short selling, not enter into a short selling contract, they would short the asset. And remember from our previous lecture, the lecture 13, we understood the concept of short selling. That's why we discussed the concept of short selling. Short selling was the concept. A quick review. Short selling is when we do not own the asset, we borrow it from someone and then we sell it, and after some time we buy it back and give it back to the person from whom we borrowed. So for arbitrage opportunity, we short sell the asset and we enter into a long forward contract to earn profit. So how would that happen? Again, we would have a timeline. This would be today and this would be after 3 months. What action would we take today and what action would we take after 3 months? So today, obviously we do not have the asset. Remember, in previous example we said we didn't have the money. In this example we do not have the money, neither we do have the asset. Previous example we also didn't have the asset, just for the clarity. So we short 1 unit of asset. So what do we mean by short the asset? We borrow it from the broker, we sell it. Once we sell it, what do we get? Remember, today's selling price is $40. So we obviously get $40. We sell it today, so we sell it at today's selling price. Then we invest that $40. The risk-free rate is 3% for 3 months. 5% for 3 months. So we deposit that $40 in the bank account for 3 months. We enter into a forward contract to buy the asset after 3 months for $39. Why are we entering into a long forward contract? Remember, long forward contract is the contract to buy the asset. Why are we entering into the long forward contract in this case? Remember, we borrowed the asset from someone, from a broker. So after 3 months, we need to return that asset. Because the forward market price is lesser, so what are we doing is, the trick that we are playing is that we are entering into a long forward contract. By long forward contract, we mean we are going to buy this asset after 3 months at $39. So now you can get an idea. We are selling it at $40 today. We are going to buy it at a cheaper price, return it back to the person from whom we borrowed. What would happen after 3 months? After 3 months, we would buy the asset. Obviously, we have a long forward contract. It's an obligation. And we would close the short position. By closing short position means that we would return the asset. And if during this process there was some dividend paid to us, we would also return that to the owner of the asset. And we have discussed this in our previous lecture 13. So by doing so, what profit would we have? The interest that we earned and the price difference that we have. So when the forward market is less than forward intrinsic, we short sell the asset. Remember, short sell is different from short forward contract. And we enter into a long forward contract. This is how we earn the profit. So we receive 40.5 from this investment, right? We have already seen this. Okay, so moving on to one more example. Consider a 4-month forward contract. By 4-month forward contract, we would mean that this contract would expire in 4 months, and that means this 4 is RT. The contract is to buy a zero coupon bond. When we say zero coupon bond, we get an idea that is non-income paying investment asset that will mature 1 year from now today. So do not confuse this 1 year maturity with this forward contract. Remember, the T that we use in the formula is the T of the forward contract, not the the time period of maturity of that asset, but the maturity of the forward contract. The current price of the bond is 930, so this is our S0. Assume the rate of interest continuously compounding, it would always be continuously compounding, is 6%. Calculate the forward price. We have our formula. The formula is F0 is equal to S0 into ERT. Because the T is 4, we divide it by 12 because the interest is per annum, so we have to multiply it. S0 is for 930. Our formula is S0 into E raised to power RT. 930 into E is constant 2.718 raised to power 0.06, the interest rate, multiply by 0.333, the answer that we get, or we can simply write 3 by 12. The intrinsic forward price is 948. Now what if in market the forward price was 950? I'm not going to answer this one. What you can do is you can discuss it or write it down with yourself, and imagine the forward market price was 930. So just argue and write it down. What strategy would you follow in this case, and then what strategy would you follow in this case, and how much would be your profit?